Well, good afternoon. My name is Spencer Levy. I'm an Executive Managing Director in Capital Markets for CBRE, and we are very pleased today to have Jim Howard, Senior Vice President and Principal from Bentall Kennedy. Bentall Kennedy is one of our largest clients at CBRE, a very large pension fund advisor. And so, Jim, welcome. Thank you for coming and joining us. Having a good conference?
It's been excellent, Spencer.
Great. Great. Well, thanks for coming out.
Oh, thank you.
Well, Jim, for our viewers, why don't we begin? Why don't you tell us a little bit about Bentall Kennedy and what you guys are looking to do?
Well, Bentall Kennedy is a pension fund advisor with about $30 billion in assets under management in North America, throughout the U.S. and Canada. And our ownership is two major pension funds and then a third owned by management. Notably, CalPERS acquired a one-third interest in our firm last year and recently appointed us as their core industrial advisor. So we're actively looking for industrial on their behalf, as well as our investment activity for our big open-ended fund, MEVT.
Great. Well, as we talked about in the prelude to this interview, you invest across all asset types.
Yes.
You have about, I think, 9% of your investments are in retail, and then you have a mix of office, industrial, and the other asset classes. Why don't you talk to us for a moment about when you're considering an investment, how do you compare and contrast retail versus some of the other investment types that you guys look to do?
Retail is an important asset class. It historically has been one that Bentall Kennedy has been underinvested in. We're currently at 9% with a target of moving that to 12, which 3% on a base of $7.5 billion is still a sizable amount of money to invest into retail. And last year we acquired two properties. One was a Woburn Mall, a very nice mix of discount and daily needs tenants with a grocery anchor in suburban Boston, and also a Kroger-anchored center in the energy corridor of Houston. So both of those deals are excellent cash flowers, really quality defensive plays playing into the improving consumer demand, and should perform quite nicely.
And you mentioned you're looking to increase to 12%. Talk to us for a moment when you're underwriting retail versus, say, office or industrial. What are some of the considerations of why a retail asset might be more or less attractive to a Bentall Kennedy from a stability of cash flow standpoint or other factors?
Spencer, you just hit it. Stability of cash flow in retail is very good. Limited additional capital requirements during the hold of the asset's nice. Very sticky tenant base and predictable cash flows make retail a nice component of a diversified open-ended national fund.
Now, Bentall Kennedy has its roots in Canada, and certainly bringing Canadian capital to the U.S. You obviously have a diversified capital base here with CalPERS and others. But have you noticed any difference in the way foreign investors look at investing in the United States versus, say, some of your domestic investors, like CalPERS, for instance?
The Canadian partners are very smart. We have a good time with them, And the investments that we're making with our partners include in the multifamily development space. We have two large $100 to $200 million multifamily developments that are underway with our Canadian partners, and then two more that are pending. And they're very actively engaged. One peculiarity or unusual feature is that they like to be less than 50% of the capital. So it requires marrying the Canadian capital with a domestic source.
So when you do that marriage of the Canadians versus another source, do you pull it out of the MEPT, or do you have a separate account?
That's what we've done. We've done it with MEPT, and then there's a second Canadian capital source, which is actually comfortable doing 100% investments themselves. So that's something we'd be working on soon.
So that's interesting because very often when we meet with these foreign investors, some are 49% restricted, some aren't. Is the distinction one is a pension fund, one's an insurance company? What's the distinction that gives one flexibility, the other not?
I think it's tax considerations,
yes.
Which I can't even do my own taxes, so I can't tell you about how they do theirs.
Generally driven by that, but there have been some foreign countries. I was recently in Israel where they changed the laws to increase the percentage that they're allowed to invest outside the United States, and certainly that drives it. But also tax considerations certainly are huge. So, in terms of your look at the capital markets, specifically in terms of the capital stack, a lot of what's driving investment decisions across the various asset types are the debt capital markets. And the debt capital markets have been obviously exceptional in multi-housing, but they've been catching up in the other asset types as well. What's been your experience recently in the debt capital markets?
Well, we're very lightly levered. I think we're only about 20% levered on the MEPT. The cases where we put leverage on, they're the assets that are going to attract the most favorable debt quotes. We just put a 50% loan on an office building that I helped acquire back in December. $160 million asset in CBD San Francisco. Really good tenants, Oracle, Yahoo, the Amazon, and also Bank of the West, and it just really appealed to the lender capital. So that was life company money. We'll probably expand our debt level from 20 to 25, but you know, that's still relatively low leverage for us. And the effective leverage, I think, is that it's a great defense against future increases in cap rates because you're locking in that great cash flow for the duration of the debt.
Now, are you trying to achieve a certain level of current yield for your investors?
Historically, over the last 30 years, MEPT's probably had about a 5% consistent cash return to the investors. Yeah, so that's something you should expect going forward.
Sure. And so just to recap what you just suggested, you're going 25 to 50%. Is that sort of your area where you consider leverage? You wouldn't push much beyond that?
And any individual asset, it's probably in the 50% range.
Okay.
With the overall funds being obviously less in the 20-25% range.
Sure. Now, you didn't mention conduits. Have you used conduits? Would you consider using conduit capital?
Be difficult, largely because the assets we're going for are the ones that are going to really attract the most efficient debt quotes, which is going to tend to be life company debt.
Sure. Well, I think some people in the conduit community might say that they're getting to be close to as efficient in certain cases as the life co. Certainly once you get outside of the main markets, conduits have been incredibly efficient. But even they've been getting more efficient in the main markets as well because of demand to put their capital out.
Right.
So let me ask you a wrap-up question.
Okay.
You know, we talked a little bit about how debt capital markets, or rather getting attractive debt, can protect you for the next several years if we see a rise in cap rates. What is your outlook over the next 3 to 5 years in real estate? And as a real estate investor, what is Bentall Kennedy doing to protect itself from changes that may be occurring in our industry?
You're asking the wrong guy. I'm not smart enough to predict things like interest rates and cap rates with any certainty. Generally, we're a in-the-market investor, so dollar cost averaging and maybe selectively placing your bets in the areas that you think you're going to do your best. We've been very active in the multifamily development business, which these are very urban, large, $100 to $250 million deals. And they follow what I call the fall out of bed strategy, where you can live next to work, you can be close to retail, you can probably do your e-commerce from bed itself. And we'll continue to do that kind of investing.
Great. Well, Jim, on behalf of CBRE, we're thrilled to have had you here today. We appreciate all we do with Bentall Kennedy. Hope you enjoy the rest of your conference. Nice job.
We are very, very appreciative of our partnerships with CB and all the good work you do for us. Thanks for having me out.
Thank you very much.
Thank
you.
All right, take care.